Hello, and welcome to another episode of Extra Crunch Live. I am Jordan Crook, and today I'm joined by my co-host, Alex Wilhelm. Alex, how are you doing today?
I'm doing fantastically well, actually. I've been looking forward to this one a lot, so really glad to be here.
Yeah, me too. Before I introduce our esteemed guest, I'll just say that I'm having internet problems a little bit. So if something weird happens with me, Alex will lead the ship home. With that, I'd like to welcome our guest. Today's speaker is going to be Plaid CEO and co-founder Zach Perret. Zach, thank you for being with us today.
Thank you so much for having me.
Go ahead, Alex. I know you're anxious to ask a question. Get in there.
So we have a lot of work stuff to get through in the next hour or so, and a lot of questions from the audience we want to bring in. But can you tell me the story of the bookshelf again behind you? Because I'm just distracted by the leaning tower of books you have just staring us down as we talk.
So I have a lot of books, like way too many books. I'm actually going to tilt my thing, and the producer said not to do that. But I have a lot of stacks of books, and they keep falling over. And then I found this wonderful bookshelf on the internet that looks like a big stack of books, but it turns out you can actually just slot them in and it holds them all up. And so now I have one, and I want a lot more of that bookshelf.
Yeah. So when we're done with this, you need to Twitter DM me where you bought that so I can buy about 4. Now, to get into the actual point of why we have you here, thank you again for coming. I want to go back to 2019. I was reading some interviews that you had done. And back in 2019, you described Plaid as kind of like building infrastructure for financial technology companies, fin services companies to enable the consumer to interact with their bank account generally via a third-party app. And I'm curious, is that what the core of Plaid was back when you founded the company? Or is that a place you guys kind of got to as you built a product out and it kind of grew as a company?
It's a great question. To answer it, I'm going to rewind us to kind of the beginning of how and when and where we started Plaid. So before we founded the company that eventually became Plaid, kind of the same infrastructure elements of the company, my co-founder and I actually built 6 different fintech products before that. And this was in like early 2012, kind of end of 2011, we started thinking about this problem. And if you remember back then, everything in financial services was built by your bank. So if you wanted to do almost anything, you either picked up a phone and called your bank, you walked into a bank branch, talked to a banker. There were very lightweight online financial applications. So maybe you could check a balance, but you certainly couldn't do much in a bank's app. And if you wanted to use a non-bank, you had to use PayPal or Mint. Those were really the only kind of digital financial at the time, because we didn't have the term fintech applications that were out there. And we were based in New York in early 2012. And if you remember at that time, we had an office, or rather we were squatting in an office that was just off of Union Square. And there were Occupy Wall Street rallies going on everywhere. Consumer frustration with financial services was incredibly high. And people just didn't feel like they were equipped to do the things in their financial lives that they wanted to do. They didn't have the tools. They didn't have the services. They didn't think the incentives were aligned. They thought the banks were out to take their money. And ultimately, what we focused on when building these fintech apps before Plaid existed was we wanted to say, hey, let's give consumers tools. Let's give them ways to better understand their money, better budget, better save, better invest. We actually built 6 of these different products, all focused on this concept of helping people better manage and understand their money.
Sure.
And we totally failed. We built all of these consumer apps, and we had 2 problems. First is the infrastructure is impossibly hard. Getting data from banks in order to build analytics on top of it to build a functioning consumer app is really hard, and we spent a bunch of time on that. Second is there's this bit of consumer psychology that we didn't understand at the time, which is if you tell someone to save more money and spend less money, they just delete your app. So we got a lot of users.
Zach, how fast is that feedback loop? Is like the first push notification that says spend less money, they just instant delete, or does that take a couple of weeks to kind of percolate through and then get them to jump out?
Yeah, it's not immediate, definitely. But it was like on the order of a month. Like if you started telling them, hey, you should spend less money, or like this thing is cheaper, or like, did you really mean to do that? You just overspent your budget. Right. Then little by little, they stop checking their app, and then eventually they never come back. Though there's a bunch of applications that actually figured out that bit of consumer psychology. So there's a lot of great books. Dan Ariely has written a bunch of stuff on the topic. He actually founded some companies to help people be smart about, I won't say tricking themselves into having the right behavior, but to help kind of use social pressure and personal pressure to help you make better financial decisions that are long-term oriented and not short-term oriented. So,
but your early attempts at this sort of application, these 6 apps that you built, they all failed pretty quickly. Is that like a 6-month window, 12-month window? How long were you working on these things before you kind of were like, all right, this is not going to work?
It's about 9 or 10 months.
Okay.
And at the time, we weren't convinced that we were going to start a company. We just liked the space, and we were frankly frustrated with the financial system. And so we worked on a series of these consumer applications. One for budgeting, one for expense management, one that recommended places that you could spend that were cheaper. And some of them were quite fun as well. So, we pulled in, at the time, Foursquare is very popular. So we pulled in a bunch of Foursquare data and allowed you to connect your credit card to Foursquare so that it would, in addition to building your budget, it would auto check you in when you swiped your card. So there was all of this like fun stuff that was going on because we understood that there needed to be some gamification to make fintech interesting. But at the end of the day, the infrastructure was the biggest problem. We were spending 80% of our time building the infrastructure. And so that's how we ended up building Plaid, which is we talked to a bunch of people in the fintech community in New York at the time, and realized that everyone was saying, well, I'd like to build something in financial services, but I don't have the tools to do so. Connecting with bank accounts doesn't make sense. The service providers were frankly non-existent. And the biggest push actually was, we had a series of people come to us and say, hey, your consumer apps are terrible, but can we license your backend?
So people knew back then that you were already figuring out how to tie in kind of like the old school banking world and the new school of like digital apps you can put on your phone. Okay. And you weren't dissuaded from how hard this was. You kind of leaned into building this plumbing part of the fintech world.
Yeah, absolutely. I think it's not like the thing. It took me, I don't know how many years, maybe 5 years to explain exactly what we do to my parents. But building infrastructure is fantastically interesting. And when you go back to the original reason that we founded the company, which is to help consumers live better financial lives, to help them have access to the tools and services they need, we're accomplishing that so well through this thesis of building infrastructure. Instead of building one product that might help one person save, we now power thousands of products that help hundreds of millions of people save, or hundreds of millions of people invest. And that has so much more impact. And so going back to the original reason, it really hit on that. And frankly, if I'm honest, I'm much better at building infrastructure than I am at understanding consumer psychology. So that part helped too.
I want to hand off to Jordan here in a second, but I was prepping for this and I was surprised to hear that when you guys eventually moved to the Bay Area from New York, brought the company there and really were trying to raise your first capital, dozens of investors turned you down. You said like 50, I think, investors turned down the company. I wanted to check. Is that correct? Is that accurate?
I think 50 is probably an understatement. I was being kind when I said that, perhaps. We had a lot of people that said no. But to be fair, we first talked to an investor when we were building a consumer app, though we didn't try to really raise for that consumer app. But then when we pivoted and said, hey, we're going to build financial services infrastructure because there's going to be a massive number of digital financial applications that come out. The investors started to ask, well, what are some examples of these digital financial applications? And we would then show them our consumer apps that we built. And they would just say like, well, I don't believe this.
Right. I don't need the Foursquare automatic credit card checking thing. Therefore, your company will fail. So you need some more kind of proof points out there. But anyways, I'm going to hand this over to Jordan to talk a little bit more about when you actually had a lot more money.
Well, before I do, I am curious about all these investors that turned you down. Have you gotten phone calls from them, in the past 2 years, like, oh man, maybe I could get in on this later stage, or, have you run into any of them? I don't expect you to necessarily name names at this point, but have you had any funny kind of come back around interactions with some of those investors?
Yeah, we've had a few of them. And look, to be fair, the investors were thoughtful and kind for the most part. And many of them actually ended up investing in our later rounds. So investing in our Series B or Series C. And so, despite the fact that the investors rejected us, we were able to build a relationship, and eventually a lot of them came around.
So I want to ask about, when the money came in, you raised like 44 million in 2016, and then 250 million in 2018. That's a huge kind of growth spurt over the course of a couple years. And I'm just curious, like what kind of things changed in the company, right? Like when you grow that fast, when you're hiring that fast, things like culture and processes and hierarchies within the organization. I mean, all of that stuff is kind of in such flux. Like, can you tell us a little bit about what that was like?
Yeah, completely. Well, maybe I'll give you a little bit of my story and how I think about it. Because the short answer is, in scaling a company, everything breaks all the time, or everything is always broken. And the job of those leading startup is to make it just a little bit less broken. But for me, it was a little bit before we raised our Series B. I'm very product oriented. Think a lot about what are the things that we can build, how can we deliver those things to customers, and then how can we have a really, really strong feedback loop. But as we kind of went into our Series B process, my ability to do anything in product land just completely got destroyed. I didn't have time. I didn't have context. I didn't have, we could hire people that were much better at delivering product than I could. And so I had this mindset shift around that time, which was going from the product is my product to the company is my product. And so now my job is to build a company that is maximally successful at doing this thing, achieving this mission. And so in that mindset shift, it became clear that there are a certain subset of things that only a founder can do or only a CEO can do. And my goal was to do those things very effectively. So things like building communication channels or building communication channels that are going to fail, but we're going to work for a certain amount of time to get you to a certain stage. Those kinds of things became what I thought of as my job. And so, scaling is hard. We talk about Dunbar's number a lot. There are these kind of multiple levels at which people forget how to communicate or are unable to communicate beyond. And so as we kind of crossed 150 to 200 people, you forget how to communicate with everyone. That also happened at 40 people, and it also happened at 400 people for us. And so you have to go back through and figure out new ways to kind of build those communication channels, build those structures, so on and so forth. For us at Plaid, we have a set of principles that kind of we hold very true. And one of those kind of principles is around openness. So at Plaid, we're a default open company where any bit of information is open to anyone. But you also, to find that information, you have to do a bit of digging. You have to go out and find it yourself. And so kind of finding these communication channels where we can make it such that information is available, but we also push people to go find that information. There's so many of these different kind of tactics that we deployed over the years, some of which worked and some of which, frankly, didn't.
I want to pull at that thread a little bit. So like when you say that information is open, does that mean that there are no like private Slack DMs within the company, or like what exactly does that mean?
So the goal is default open. You can think of this like as on the path to transparency, with an understanding that being fully transparent as a company is an impossible thing to do. For example, there are HR files. You wouldn't be transparent about HR files, right? But our goal is to be default open. I'm a big believer that as a company, you achieve everything through the actions and the work produced by the individuals. And as a manager and as a leader, your job is to empower the individuals, give them all the tools that they need, and then get the heck out of the way so that they can go actually do the work of the company and create massive impact. And so as a leader, my job is to make sure that no one is blocked by lack of access to information. So if I'm an engineer working on a feature, I need to understand the entire history of that. I might have a question. So, we want to make it such that that engineer has access to the support request that someone sent in, and also to the product doc that the product manager put together when scoping the feature. And so you can kind of think of that concept of there's a kind of seamless chain of information to give everyone context on all of the important things that are happening within the company. And then on top of that, we try to build a set of guides or channels. So if you are kind of on the engineering team, well, then you have kind of this map effectively of all the information that's out there, so we can point you in the right direction to the right set of things.
Is that something that you guys built yourself, like this open kind of shared information platform, or is that something you use a third party for? Because I know that there are a bunch of startups that are looking to like kind of map the like the knowledge graph of a company, right?
Yeah, I wish there were better software, but a lot of it is just bits and pieces that we built ourselves. So we started on top of email. When we founded Plaid, chat was not that big in an organization. It was pre-Slack. We started using HipChat early on, but even before that, we were just using GChat. And so email was our default communication channel. And so what we built was a ton of automation on top of email. So kind of forwarding lists, kind of like lists that would hold information, lists that would have long-term data in it. Then we built, of course, like folder structures. So we built all this stuff into Google Docs and into this Google Doc hierarchy. And then we built kind of mapping on top of that, and mapping lives within our wiki. So a lot of it is just a commitment towards open information and then building the right levels of guides. But we haven't found a great bit of software to solve this problem. And if some entrepreneur is working on that bit of software, I would love to hear from them, because it is still a lot of overhead to maintain kind of this concept of a resource library.
And then I want to just ask one more question when it comes to like communication and scaling, which is you mentioned that at certain kind of benchmarks, number of employees, that communication broke and we had to kind of rebuild or adjust. I think I get a picture of the 40 person mark, but maybe later on down the road at the 150, 200, or even at the 400 person mark, what were you doing before and what did you kind of change?
Well, I would say around, it was probably closer to 160 or 170. We had a big shift in the company. So two things happened. First is just naturally, by having so many people, you end up unable to remember who all of the other people are. So there's this concept called Dunbar's number, wherein it says, and I'm going to totally butcher this, so please go look it up on Wikipedia. But wherein it says something like at sub 200 people, you can mostly remember all of the other people in that unit, and at 250 people, say, you won't know who all the people are, and you won't know what they do. And at sub 40, you can remember all the relationships between all the people as well. But once you cross 40, you suddenly don't have that either. And so for us, we naturally grew past kind of 160 or so. And then we started hiring people quickly, and all of the existing people didn't know who the new people were, and it took too long for the new people to know who the existing people were. So that was an issue. Second is we bought a company. And that was a really big jump for us. We bought a company when we were just about 200 people, maybe just a few less than that. And we bought a company in New York. And we loved this company. We loved the culture. We loved the product that they built. And so we wanted to integrate them as much as we could. But going from a team of just under 200 at the time, and then adding almost 90 additional people into the company was a big leap for us. And so we went from something that was primarily focused on synchronous culture building, synchronous communication, to something that had to go much more asynchronous. So lots more writing even than we'd already done. And we write a lot as a company, but lots more writing than we'd already done. And my job in many ways shifted as well, because all of a sudden I could expect previously that the people around me understood the vision and they understood the strategy just by sheer me talking about it, and other leaders at the company talking about it. Yet all of a sudden you have these 90 new people who first had a different strategy until the day that the transaction closed. And so now we have to share with them what ours is, and frankly, evolve ours to include their viewpoints. And then second, they're not there with you. You can't just kind of walk around and talk about why you really care about this bit of the market, or why you really care about figuring out how to serve underserved communities. It turns out you have to write that down, and then you have to write it well, and you have to talk about it a lot. I actually make this joke now when people ask me what I do. I say that amongst other things, about a quarter of my job is just repeating myself. And to me, I consider that boring, because I'm saying the stuff that I say all the time. But to the company, it's actually crucial, and I have to remind myself constantly that that is an important bit of what I do.
It's a huge part. I've heard a lot of CEOs and founders say that at a certain point their job becomes just a lot of repetition, and sometimes it's slightly different. Sometimes you say it in a different way, but at the end of the day, you're just hitting home this message that you need to make sure everybody kind of internalizes. I'm gonna pass back over to Alex to ask some questions. I know we can't go super granular on the Visa acquisition, but I do want to ask you some questions around decision making and stuff. But before I do, I just want to remind our audience, you can ask your own questions. Just please use the Q&A function and not the chat feature, because we won't be monitoring the chat. but go ahead and ask your own questions. We'll incorporate as many of them as we can. With that, I'm going to hand to Alex. Take it away, bud.
Yeah. So I want to touch back on the 2018 round because I'm fascinated by this one. A lot of companies in the last 5-10 years have seen huge step functions in how much money they raised in kind of one go. You guys went from raising 44 million at about $250 million valuation, if media reports are true from back then, to raising $250 million kind of in one go. So you just had so much more access to resources suddenly as a business. You could hire more, you could spend more money on sales and marketing. When you get a check like that, how do you plan about resource deployment? Do you go kind of like 0 to 60 as fast as you can? Do you incrementally scale up your hiring speed and marketing spend? How did you approach going from scrappy to rich?
Well, I hope that we never consider ourselves to be rich.
Fair enough.
That would perhaps change the culture in a way that we wouldn't want. But so it's actually an interesting story. We raised in 2016 quite early and at the very end of 2018. So I believe it was announced in December, perhaps. And in that period, it was over 2.5 years between when we raised, which is quite a long time for a company, at least these days in Silicon Valley, to go between fundraisers. Kind of after the Series B, which was the $44 million round in 2016, we actually built a profitable company, and we were growing quite well and had fantastic compounding kind of like growth curves, and things looked really, really good. And if I'm totally honest, the round in 2018 was not a necessary round per se, other than the fact that we were planning to buy a company. So if we were going to deploy a bit of our remaining cash in order to acquire this company, we wanted to be sure we had sufficient buffer, as well as putting, if we were going to do a raise, we'd rather do a raise once and not twice. So putting enough cash on the balance sheet to go forward. Before and after the round, aside from the acquisition, I'm not sure that a great deal changed. Our mindset didn't shift all that much. We are perhaps fortunate in many senses to be in an industry where advertising dollars, we can't just go dump a bunch of money on advertising and magically a bunch of new customers appear. When selling to developers and building infrastructure products, the cycle time is much longer, and frankly, the buyers don't react to advertising very well. I'm not sure if you've encountered this, but if you put an ad in front of a developer, oftentimes they will not only not click your ad, but perhaps in the back of their mind register the fact that you did a lot of advertising in this place that they didn't want to see advertising, and then avoid your product perhaps in the future. So there's not the same tool as in consumer companies where you can just advertise. So that's good and bad. It's good in that you spend less money on advertising, and it's bad in that to figure out other ways to acquire customers. And so for us, it is a very much a long-term compounding business. We think about finding fantastic fintech developers, ideally at their earliest stages, though we'll sell to anyone at any stage. But a lot of our big customers now we found right when they were starting. So we started working with Venmo when there were maybe 25, 30 people. And over time, they grow into these massive, successful companies. And so as a culture and as an organization, we very much orient towards long-term growth. When we talk about what we're optimizing for in any given year, we're optimizing for the kind of the set of metrics that will have the maximum impact on the company 3 years from now or 5 years from now. When we talk to our product team about what their job is to maximize forward enterprise value, not day-to-day enterprise value. And so I would say culturally, we'd had this really strong focus on do the things now that will have long-term impact, which meant that, aside from now having a lot of new colleagues, which was fantastic, the 2018 raise didn't change all that much about our thought process or the interactions that we had.
I think you're in the minority there by not accidentally spending way too much money when you raise. I mean, Dropbox, for example, had to go through kind of a very public, about face on how they approach cost controls after they raised, I think an ocean of capital. So I'm glad to hear that. But I want to talk a little bit about the profitability point that you brought up. Profitability is great, but a bit of a squishy term in startup land. So when you talk about profitability, are you talking about free cash flow positivity, or adjusted EBITDA, or actually like GAAP net income as the profitability rubric you're using there? Without getting in trouble, naturally.
Yeah, without actually disclosing numbers, the way that we tend to actually think about it is more in kind of what do I say, like the traditional GAAP sense, as opposed to kind of unit profitability or otherwise. However, accounting in Silicon Valley has many different terms. and for many businesses, I think the most important part to figure out is what is the metric that ideally single metric that drives the future for you. So for us, that metric, the thing that we think about the most and think that we truly optimize for, whether or not that means GAAP profitable or not GAAP profitable, the metric that we drive towards is this concept of a connected account. So how many people have connected their accounts to financial technology applications, which is the best metric for understanding how useful is fintech? Are people using fintech products? And so we actually feel fortunate that in the very early days of the company, we put a set of metrics on the wall. Anyway, we have this dashboard.
Sure.
And one of those metrics is still the same metric that we actually track every day. And so when we do our goals for the year, we still have the same concept of connected accounts being one of our primary goals, because it's the leading indicator of long-term success or of long-term usage or long-term growth, and it correlates with kind of our long-term revenue.
And you said at the top of the chat that you're now in the 9-figure connected accounts, like over 100 million of these. I think you said at the stop. Is that true?
We have quite a few, yes.
Quite a few. Okay, because I'm curious now. Like, now you're doubling at that scale. Like, how long until you get to 1 billion of them? Is the next question that I would be curious to hear about. I don't know if you can talk about it.
I think it's important to think a bit more broadly. So when we think about this concept of kind of fintech usage, so on and so forth, there's a US component to it. There's an international component to it. Obviously, the US has less than 1 billion people in it. And as we think about kind of further growth and further expansion, one of the things that we're really thinking about over the coming years is how do we continue to expand the product internationally. And so, there's lots of work to do, certainly, as we think about key metrics ahead and growth rates and so on and so forth. However, international is one of those important bits that we've been digging into for now well over a year, and it's initial focus in Europe. But it's been difficult in a positive sense, in that, like, we've had a lot of success. However, the changes, the differences in the financial system require a great deal of work and effort.
Yeah, it's going to be interesting to see how companies that are trying to build the Plaid of X, like Plaid of Mexico or so forth, kind of end up competing against you guys. And if you end up just squashing them, buying them, or losing to them, this is like a 5-year conversation, but I'm really excited to see how that plays out across different continents, because you guys have shown that this model works in one place, a couple places. There's a lot more countries out there. Okay, let's not beat around the bush anymore. I talk a little bit about this, the eventual acquisition that was announced in January of this year and is now still closing. So I know there's rules about this. But it seems, based on our conversation, that even early on, Plaid was doing very well, had the metrics that investors were excited about, had a lot of attention, frankly. How early, I'm curious, did acquisition offers begin to kind of crop up? Was it 2016, 2017? When did they first start to kind of appear on your radar?
So acquisition offers come to startups in a variety of formats at a variety of times. And whether it's an offhand mention or a serious acquisition offer, sure. It certainly varies. We've had a number of them throughout the years. To be frank, though, what I think about whenever these things came up is our mission. So how can we have the impact that we want to have on consumers in the way that we want to have it? One of our core mantras as a company is make money easier for everyone. We think about this concept of kind of taking a financial services ecosystem in which you had to walk into a physical bank branch in order to get a loan, and then moving that to a world where today you can not just go on the internet. Lending Club, amongst many of its wonderful features, the best thing that I think they did early on was put the loan on the internet, so you now no longer have to walk into a bank branch. So rewind 10 years, you're walking to a bank branch. Fast forward 5 years to 5 years ago, now you can get a loan on the internet. Now today, there are hundreds of businesses that will give you a loan on the internet. And through that, the rates have gone down, the quality of service has gone up, the communication has gone up, you can do things on your phone, time, all of these fantastic benefits for consumers. And so for us, that is our mission, right? We want to create an ecosystem where there are many applications available to consumers, and through either competition or just technical innovation, the quality of product delivered to consumers goes through the roof. And today, I would argue that our financial lives are dramatically simpler and dramatically better because we have 5 to 10 to 20 things in a finance folder on our iPhone or Android instead of having to walk into a physical bank branch. and so that is the vision for the company. That is where we want to go, and we believe we've just scratched the surface. There's so much more to do. So when the Visa acquisition came along, our first reaction was, no, we're focused. Go away. Like, leave us alone. We've got stuff to do. Over time, we kind of dug deeper and realized that there is just this fantastic kind of long-term vision overlap with what Visa's building and where they're going and what they're doing. Frankly, we got along quite well. There was high values overlap. But the most important piece for us was that we believed that we could accomplish our mission in a faster way by working with Visa. And so for us, that is the only thing that really drives an acquisition conversation is, can we achieve this mission that we hope to achieve in a faster, better way?
So before, it wasn't that the acquisitions were not quite the right price that you wanted, or not quite, whatever the cash stock mix, but more that it was, they weren't going to help you accelerate your vision and do what you were hoping to do faster, and therefore why pursue them as an option?
Exactly. So the way that I've shared this many times with our company, and I think I've talked about it externally as well. My evaluation criteria, number one is achievement of the mission. Are we going to accelerate towards the mission? And the mantra actually for the conversation was, how are we going to accelerate towards our mission? How are we going to do this thing faster and better and more completely with more services, so on and so forth. And second is the team. Is this a thing that is going to can motivate the team, keep driving the team? Because I go back to one, if the team is focused on the right things, then we achieve the mission even better.
Okay, I'm going to hand this back to Jordan because I've been going a little bit long, but thank you for that.
Yeah, I'm wondering, when the acquisition crosses the table, right? Or maybe before the acquisition crosses the table, there's definitely evidence to show that strong fundamentals very well could have gone public, in relatively shorter time frame than I think many would expect. And then there was also obviously the option to continue to raise money, stay private, and kind of stay on your path. Obviously, moving quickly and kind of getting to that mission quickly was a top line priority for you. But before Visa comes on deck, were you kind of thinking going public, or was the opportunity to be acquired something that was on your radar? And how do you, beyond getting to the mission faster, how else do you evaluate that?
So Jordan, you broke up just a little bit in the middle, but I'm going to answer the question I think you asked, and you can tell me if I answer it wrong. For us, I'm gonna answer in almost the same way that I answered Alex's question, which is, it really drives towards how do we achieve the mission faster? How can we accelerate towards that mission? And as we were talking about metrics, we have a set of metrics that for us drive the best picture that we can of, are we achieving this mission? So connected accounts being one of them. There's a variety of other metrics that sit behind that. And so as we were kind of considering this acquisition offer, we'd been approached with other things in the past. The question really was, are we going to be able to go achieve that vision? And specifically, how is that vision going to, or how would this change impact those key metrics that we really think about? And thus, can we actually measure the impact that it would have on the future acceleration of the mission? So truly, everything goes back to this concept of, are we making money easier for people? Are we helping consumers live better financial lives? Our strategy for doing so is building a massive, massive fintech community, a massive fintech ecosystem. And so kind of do all of these pieces work together? Are we able to help the fintech ecosystem achieve what it needs to achieve, which then helps consumers achieve what it needs to achieve? And along the way, are we helping the banks grow and serve their consumers in a fundamentally better way? And those are the three constituencies. And that kind of all drives into, again, these key metrics and then this concept of achieving the mission.
So I don't expect you to fully pull back the curtain on this, but I am curious, this acquisition comes across the desk. You have to talk to the board about it, talk to your investors about it, and talk to your employees about it. What were those conversations like? Was there pushback? Was there an argument? Was it pretty much unanimous? This is the right way to go? What were those conversations like?
They were difficult. They were difficult not because people disagreed. But they were difficult because I had a hard time deciding. I love what we've built. I love the team and the culture that we've put together. I feel it's unique, it's growing, it's dynamic. When people ask me what's the culture of Plaid, I say, please go talk to the people, because the people at Plaid determine the culture. My only job is to hire great people according to our principles, and then give them the tools that they need to impact the culture and grow the culture in a way that they feel is truly unique and best for the company. And it's a really, really special thing that I believe we've put together. We have a unique opportunity to create a massive impact on hundreds of millions, if not soon, hopefully, billions of consumers. We are in an industry that previously didn't really exist. It's not as if we're coming in and moving TAM from one player to another. We're creating TAM, both from what we do and then also from all of the products that are built on top of Plaid. So it's a really, really unique opportunity. And for me, it's an incredibly hard decision. It's a bit of a bet that I believe that we can accelerate by working with Visa, by having access to their resources, by having access to the relationships that they have, the infrastructure that they have, so on and so forth. It's a bet. I think it's the right bet. But I feel so fortunate to be in a position where we've built a company that has so many amazing things going together, that it's also a risk. And so for me, that's the struggle, which is, do I make this bet that I truly, truly believe is the right bet? But also, how do I cope with the risk of me potentially being wrong? I'm pretty convinced that it's the right move. But ask me again in a year, and I'll tell you.
I'm going to mark that down on my calendar. I have a couple questions from the audience, Zach, if you're. One is from an anonymous audience member who asks, if you were starting a fintech company today, what areas of fintech would you be most excited about?
That's a great question. So the answer, if I were starting a fintech company today, I would be focused on unbanked and underbanked. If you look at the numbers in the US, 6% of the population is unbanked and 16% is underbanked. 6% of the population is underbanked or is unbanked. That is shocking. That means that they don't actually have a bank account. Underbanked, again, not having the tools and services they need. That's a combined 22% of the population for whom they are desperately looking for financial services, desperately looking for tools, they're desperately looking for help. That is a fantastic starting market. That is a market with people with very high demand, and a market that, frankly, will have a lot of loyalty if one is able to solve their very fundamental problems. That's probably where I'd start. I think over time, other things that I'm particularly interested in are financial education and financial empowerment, building the toolkit to help people really think about how to manage their financial life. We have a lot of fantastic tools and services for those that have money, but we don't have that many great tools and services for those that don't have all that much money. There was a report that came out about a month ago that talked about the overdraft fees in the U.S. It's about $11 billion of overdraft fees, and it's something like 85% or so of those overdraft fees come from 10% of accounts, and those accounts have an average of $350 in them. Yep. That's a great target to go after. Clearly, all of those people who are getting charged these massive amount of overdraft fees would be frustrated with their banks. There's great tools and services to be built to solve that, whether that means tools and services to help people avoid overdraft with their existing bank, or perhaps building a neobank that doesn't have the same overdraft fees. There's a really great market at the bottom end of our kind of wealth stack, and I would love to go address that. I think that'd be a fantastic place to start.
Yeah. So I've been thinking a lot about this, because one of the best things about neobanks, in my personal view, is that you don't have to have a lot of money on them to get good service, to get no fee checking accounts and all these things that you get when you have a little bit of money in the traditional world, and you wouldn't have gotten with the old banking structure. So in my view, a lot of the fintech, fin services innovation we've seen lately has been relatively consumer friendly, and therefore going to the root of what you're saying about making this a bit more fair and less high fee for people with less money. My question is, how long can that keep happening? Because right now it feels like a lot of these companies that are in the fintech world are fighting each other to provide the most for the least. But eventually they're going to have a perspective more focused on profitability than growth, and they might have a different kind of pricing pressure to them. So I'm curious if you think that the fintech boom, such as it is, in that it helps people with less money, can persist, or if this is more like a historical quirk and we're going to see these neobanks become a bit more like traditional banks and be more fee heavy in time.
So certainly, I don't need to quote this to you because you've heard it a million times, but the quote of software eating the world. My corollary to that is every company is a fintech company. And certainly every financial services company should be a fintech company. When you think about the cost to serve for a traditional financial institution, they have a lot of legacy. They have a branch network that has a lot of people in those branches. You're paying rent, you're paying salaries to people that are there. You have a massive ATM network, whether it's your own ATM network or you're plugging into another, you're paying massive amounts of fees on top of that in order to have this ATM network. Oftentimes you have a lot of humans that are in the loop doing a lot of fundamental things. So you think about the loan processing market. There are a lot of humans that are calling and saying, hey, do you have this bit of data? Can you fax me that bit of data so I can type it into my system? And neobanks have the opportunity to start from the ground up with no humans in the loop and all software. What that means is that their fundamental cost to serve is very, very low. If you look at the cost to serve for, and I believe these numbers came out a little while ago, the cost to serve for a city customer, it's above $300. However, for a neobank, they can make it dramatically less. And so I do think that there's the opportunity to build fantastically successful, long-term profitable businesses in a way that just reduces a lot of the cost to serve to these consumers and allows for, frankly, quite a lot of upside. The last point I'll make on this is that we're in a very unique time where people are, for the first time often, experiencing financial services or experiencing digital financial services. We've seen a huge boom in sign-up rates for fintech applications. And when I say fintech, I don't just mean digital financial applications built by startups or technology companies. I truly mean built by any company that is leaning into digital finance. We've seen something like a 42% increase over the months of March and April of overall fintech installs. That's insane.
You stole my segue. I was going to ask if you were seeing, if via the Plaid APIs, a boom in savings and investing applications next. So keep talking about that.
So that's not just to investing and savings, that's to overall digital finance. But 42% increase in signup rates, which is shockingly high. PayPal released some stats somewhat recently saying that a lot of their recent signups, they have obviously seen a boom as well in the past few months, but a lot of their signups are from people in the 50 plus age category. Yeah. And so now what we're seeing is that people who historically would walk into a bank branch or maybe talk to the banker or whatever it is, they're now saying, well, I have no other choice because the bank branches are maybe closed or certainly they're running at reduced capacity, but I can't walk in. And now I need to find a different way. And so it's been really exciting and interesting to see first-time signups. My hunch is as kind of we figure out how to reopen the economy, as people can start to go back to the bank branches that they traditionally went to, a lot of people will do that. And so perhaps all of these signups won't be long-term sustainable, but I suspect we've reached a new normal. We've taken kind of a step up the curve, and these people that have never before experienced digital finance experienced it for the first time, hopefully in a good way, and are willing to continue to maybe not exclusively use digital finance, but at least partially use digital finance.
Yeah, I like that. I'm curious how much higher the price would have been with Visa if they tried to buy you now versus January. But we have a lot of audience Q&As to get to, so I'm going to throw back to Jordan really quick.
Yeah, so we have a question from Deepak, and actually several of our audience members have asked a little bit about crypto, but I'm going to phrase it the way Deepak did. Do you think that crypto and decentralized solutions have a future in helping the unbanked?
Oh, I hope so. So I will be the first to admit I'm not an expert in cryptocurrency. We are fortunate to work with a lot of cryptocurrency companies, helping them figure out how to convert fiat dollars into crypto. So on the kind of dollars to crypto exchange side, and I've learned a bit through that. I do believe as we think about unbanked and underbanked. Unbanked in the US is a shockingly high number, particularly for the level of development of our financial system, and underbanked likewise. As you look further internationally, many countries have something like 30, 40, 50, sometimes more percent of their populations that don't have bank accounts. There's a lot of solutions for that. Many have leaned into things like working with mobile carriers to actually build a quasi bank account that is linked to your phone. But I hope that crypto can solve a lot of those problems. I suspect that we might see earlier initial adoption outside the US, but I really do hope that crypto is able to help there. I'm excited to look back in 10 or 15 years and see how this evolved. I have no prediction on the direction that it's going to go. But if I looked back 10 or 15 years from now, I would suspect that crypto will play a major role.
Yeah. So we have another question from Tom this time. He says, early stage founder here. What advice would you give yourself in the early days of Plaid when you were going through your search for product market fit and traction? What was the top 1 or 2 lessons you learned going through that iterative process?
That's a great question. So we searched for product market fit just once and found it once, but they were not the same. So we searched for product market fit with our consumer products, and frankly, we never found it. What we did find was that someone said, "Hey, can we license your backend?" And that was kind of product market fit thrust upon us as we started to go out and really push down this path. Perhaps the more relevant experience, though, is thinking about additional products that we've been offering. So my belief there's a kind of a two-part process. One is listening to and understanding what customers are asking or potential customers are asking for. And the second is figuring out what they're actually asking for. And those are not the same process. The first one is relatively straightforward. You can do customer interviews, you can ask, so on and so forth. The second one takes what I think of as a prepared mind. So having spent a lot of time thinking about a set of problems, your intuition as to understanding, well, if the customer asks for X, they actually really probably are looking for Y, and the only way I'm going to build Y is through doing kind of A, B, and C, and kind of having that intuition of what you actually need to build for the customer. So it's been for us an iterative process, certainly, and I don't think that there's any magic answer to it, but I do believe that talking to customers is the starting point. However, building the things that you need to build, at least for us, has worked a little bit better.
Before we do a kind of a last couple audience Q&As, I want to talk about what you're seeing via Plaid usage. You mentioned a few minutes ago that you've seen 42% growth in kind of fintech application installs or something, which is a huge amount of growth in a short period of time. Are there certain trends inside that data? Maybe new types of apps that are coming up, new services that are being built that are finding their kind of first audience. Anything that you're seeing kind of bubbling up from the Plaid data that might have surprised you in the last 6 months? The world has changed a lot. I'm curious if we've changed what we're building and using.
Yeah. So first, I'll note the 42% stat is not based on Plaid data. That's based on industry data.
Okay.
I wouldn't release Plaid stats specifically like that.
I got excited.
So we have seen a lot of increased adoption of different segments of fintech. So first, some of this will be quite obvious. In the early stages of lockdown and COVID, we saw a pullback in lending use cases. Consumer lending applications were down. Mortgage lending applications, despite the fact that interest rates were low, mortgage applications weren't being fulfilled, and so mortgage lending went down. Small business lending also went down, with the exception of PPP. Further along in the cycle, we started to see an emergence and a massive growth rate in two areas. First is investing. So both brokerages and also more kind of investing tools, things like Stash or Acorns, where they help people think about long-term investing and savings. And then the second area that we saw a lot of growth in is peer-to-peer payments, because all of a sudden people were not as much walking into retailers and paying for a thing, but they were sending each other a couple bucks. And I don't understand the underlying consumer behavior fully there, but we saw a massive number of people paying what we think is paying friends back for money that they owed them. Then that actually persisted. And so if you look at some of the public numbers that Square Cash and PayPal have released, it shows quite rapid growth in this period. And then looking ahead, this is the area that I think a lot about, which is what should we be seeing, or what do we hope to see? So PPP lending has grown quite a lot. We're starting to see, I hope we will at least start to see a resurgence in some of the small business lending categories. I suspect that we'll start to see growth in the consumer savings categories. What we've noticed is that a lot of consumers, the savings rate on average is much higher these days than it was previously. It's gone from, I actually don't remember the exact stats here, but I believe we're saving somewhere between 30 and 50% of what we earn, which is much higher than consumers have been saving before. So I suspect that savings-centric products will continue to grow. And I hope that long-term investing-oriented products will continue to grow. I hope that people aren't just saving in checking accounts, but they're also saving in kind of long-term oriented investment accounts. And then on the business side, I think that we're going to see a continued emergence of kind of automated tooling. So things like automated accounting services, automated bookkeeping services, things that help people manage their money and keep track of their finances on an ongoing basis.
I'm going to squeeze in one more here before we go back to the last two audience Q questions. I was talking to a company called Treasury Prime, and they've built APIs that help automate internal banking processes to kind of bring that cost down for a lot of companies. And they reminded me a little bit of Plaid in that they're taking kind of an opaque, tough part of the financial world, making it digestible and consumable via an API. And I'm curious if there's still, in your view, white space inside of the financial world that needs the same sort of APIs and tech work that you guys did to your part of the fintech world just to be done. And if there's room for startups to go out there and really attack a lot of the financial technology world with new APIs and new products, or if we've kind of colored in the edges a bit and we're not working on plumbing as much as we might have, 10 years ago.
I think that as we've seen historically, anyone that bets against technological innovation is usually wrong. True. So the easy answer is, of course, there's so much more white space and so much more that we can and really should be doing. One of the interesting trends that we've seen is that we've gone from this concept of kind of like fintech being amongst small companies to every company being a fintech company. And that means for us that we see companies that are building digital financial solutions that are, yes, both small, also very large technology companies. We've seen a lot of companies that traditionally you wouldn't think of as financial services companies building financial services tools. One example is in lending. Let's take auto lending, for example. We actually saw and have been seeing for a while a number of car dealerships come and say, hey, I'd like to build a lending product, and I need this bit of data in order to plug into this broader lending product that I'm creating. All right, well, you'd never consider a car dealership to be a financial services company. However, they do a lot of it. If you look at Airbnb, for example, Airbnb is not a financial services company, yet they have a massive fintech team. On the order of more than 200 or 300 people that are building their fintech and payment stack. It turns out Airbnb, they're also a fintech company. And you can kind of apply this across almost every business that has a repeat financial interaction with a consumer. In my mind, there's kind of this Venn diagram. On one side, you have commerce, which is paying for things, paying for goods and services. On the other side, you have financial services, which is everything that you do with your money that is not paying for things. So investing, savings, lending, so on and so forth. And there's a bit of overlap, yes, of course, between the two. But this financial services side, it needs infrastructure, it needs plumbing, it needs, particularly, it needs a lot of the tools that commerce has had for so long. We have fantastic tools on the commerce side. And so our belief long-term as Plaid is that we'll build a lot of those bits and pieces, but we're not going to build all of them. There's so much more space still to build. So I hope that we will see more infrastructure focused on kind of enabling digital financial services broadly.
Cool. Jordan, back over to you.
So Zach, I have a couple more audience questions. I have a couple Jordan questions, and then we're going to close it out. So I think we're right around the perfect timing for that. One of the members of the audience, and actually several people have asked kind of questions in this thread, but what is Plaid's position or approach on data sharing and collection while maintaining transparency with clients and the liability held by financial institutions?
It's a great question. So from the beginning at Plaid, we've had a conversation about what we call data ethics. And what that means is that we've always been talking with our team internally and with the industry more broadly about whose data is it, how can data be used, where should it go, and what are the protections that we need to have in place to make sure that it is being used appropriately. So starting from kind of the first question of whose data is it, ultimately any data that is about a consumer's financial life, we believe is the consumer's data. The consumer is the owner of the data. They have the right to use that data. They have the right to permission that data. And indeed, one of the kind of the core theses behind Plaid is that the consumers need their data in a functional format. So think about it as a budgeting product. If someone is building, or if an application builds a budgeting product, and the consumer needs to use that budgeting product, there's one of two ways to get the data in. Either you type it all in, or you connect it. Our job as Plaid is to act as the agent of the consumer to go get the data from their bank and pass it back to the consumer inside the budgeting app. And so what we believe is that the consumer is the owner of that data. And perhaps the bank also has a copy, and perhaps for a time, Plaid will have a copy of that data as we're passing it to the application that the consumer is using. Along the way, what are the things that might happen to that data? Well, we think very little should happen to that data. We can do things like build analysis on top of it to clean the data and then pass that back to the consumer. And from time to time, we use some of the aggregate data to look for things like fraud. So are we seeing atypical usage or signups on a bunch of consumer signups to a certain application, and should we block that? But we really believe that the data that goes through the system, financial data, is the consumer's own data. We believe that the consumer needs a set of rights around that data. They also need a set of tools to help them manage and understand where that data is going. And so for us as Plaid, this has been the conversation, for quite a long time. I think this concept of data ethics, how data can be used, it's not consistent across all industries. Certainly you see in kind of the advertising, social media world, different questions about use of data, so on and so forth. Financial services has to stand apart, I truly believe. And I hope that Plaid can continue to be a leader in this space, and that we can help kind of share and more broadly view this concept of data ethics across the entire ecosystem.
Right. Okay, a slightly easier question, I think, or maybe not. Alex asks, what's one book that you feel helped you most in your career or as an entrepreneur? Hard to pick one.
Yeah, it's almost impossible to talk about that. What I will say, so I'm not going to name a specific book, but I will say there's a certain set of kind of like biographies that I've really quite enjoyed. So I read a lot of nonfiction, but there's a set of biographies of builders that are particularly interesting that I've really enjoyed. So there's a fantastic Benjamin Franklin biography that I thought quite a lot about. Hopefully you've read something about Edison. Hopefully you'll kind of go back and find the key inventors, perhaps even before we think about modern technology companies, thinking about what invention used to look like. And that trend of biographies has been one of my favorites.
Maybe after the call, you could email me a few of your favorites, and we can include it in the post that we do recapping.
Sure, I will do my best to keep the list manageable.
Great, thanks. Okay, final questions. I'm sure that you're well aware of what's been going on in our country around the protests following the murder of George Floyd and the Black Lives Matter movement. I think it's definitely forced the tech industry to look inward and reflect on our progress in terms of equity and inclusion. Clearly, Plaid has the potential to democratize and bring more equity into just the financial landscape of our country and beyond. But, I think that a lot of founders and entrepreneurs are looking at their companies, looking at, the things that they can control essentially, and trying to figure out what they can do and how they can do better. When all of this kind of took the global stage, what went through your mind, and what has changed at Plaid, if anything, in terms of creating more diversity and inclusion and equity within the workforce?
It's a great question, and I have a few minutes to respond.
Yeah,
to this,
please go ahead.
It's a topic I care quite a lot about, and it's frankly an area that I deeply believe Plaid can have a massive impact. So I think of it in two categories. First is, what can we do as a company, just period. No matter what we build, no matter what we do, what can we do as a company to increase racial equity, to increase representation, to increase diversity? And we have a large handful of things that, many of which we've been doing for a while, that we're reinvesting in, some of which we're doing additionally, and really leaning into. The focus here is on supporting our community as a company within Plaid, and then the broader tech community. So thinking about programs around how do we continue to hire underrepresented groups, particularly Blacks, into technology roles. How do we continue to ensure that we have kind of proper throughput and promotion cycles and pay equity and all of those things? So there's actually a large handful of initiatives that we've been working on over kind of a little while and really are reinvesting in now within the company. But the broader thing that I hope that Plaid is uniquely positioned to help with is this concept of financial inequality. If you look at some of the stats, it is shocking, and the history of financial services has not been an equitable one. So if you look at the average wealth for a Black family versus a white family, it's 1/10 that of a white family. If you look at the average indebtedness, Black families are only 1/3 of the average in the US. However, they are paying kind of greater than the average in terms of fees. So the interest rates are so high, or the fee rates are so high, that Black families are massively more affected. And keep in mind, 1/3 versus 1/10 in wealth, that also means that their percentage indebtedness is much higher. So as we think about these things, and then we look back into the history a bit, we start to realize that financial services has a history of things like redlining, which I encourage you all to read about. But basically, what it means is you're taking a given neighborhood, or you're taking a given racial segment, and you're saying you're going to have differentially worse access to loan rates, or you're going to get rejected more frequently for credit card applications or loan applications. And that's an area I think Plaid can help a lot with. So this concept of financial inclusion, financial equality, that's something that's always been held very deeply inside of Plaid. We have this concept of making money easier for everyone, making financial services available to everyone. And one of our core tenets is access. Some of the things that kind of we've been doing are focused around kind of ensuring that we have all Black-focused community banks available on Plaid, and making sure that they're working really, really well. So that's something that we've been leaning into recently. Also doing things like ensuring kind of fairness reviews when we're launching new products and so forth. But more broadly, a few of the areas that we're now considering, hey, can we lean into a little bit more? One is around this concept of financial education. So I mentioned it a little bit earlier, but we would love to build more programs, and frankly, are currently digging in on ways that we can build more programs around financial education. And then the second is just continuing to work with fintech companies that are focused on the most vulnerable populations, and ensuring that everyone has access. This concept of unbanked, that is not, that 6% that we talked about being unbanked, that is not distributed across our population. That's focused on certain communities and certain races. And that's an area, as I spoke about previously, it's an area I think that we can really, really help. And if I were founding a fintech company today, and hopefully someone hears this and thinks about it, it's an area that I'd be really focused on. So we would love to help. We'd love to do more. And I believe that Plaid can have a massive impact on solving financial inequality.
Thanks, Zach. Last question before we go. I know we're a little bit over time. Peak and pit. My family does this sometimes at the end of the day. As an entrepreneur, what was your peak? What was your pit?
For all of Plaid, or for today?
No, for all of today. I mean, for all of your career, like the whole time. I don't care about your peak and pit today. Like
I think the lag makes that even funnier to hear, I think. Overall.
Sorry, am I lagging? I'm lagging.
You are. To repeat that though, she means for the whole Plaid tenure, I think.
Yeah.
Oh man, there are so many peaks. like there are things that are constantly ongoing. So one of them is like our hackathons are one of the most fun times that we have at Plaid. We actually, the first time that we got any recognition as Plaid was winning a TechCrunch Disrupt hackathon, where Jordan, I don't know if you'll remember, but you and I actually met and had a conversation.
I totally remember. I totally
that's a lie.
And that's something that we do. We do now 3 times a year. We do full company hackathon. Everyone has to participate. Truly, everyone has to participate. And so, having this massive energy focused around creation of what is the future for Plaid, and those are so much fun. I would say I really, really enjoy those. And the fortunate thing is, it's not just one peak; you get 3 of them a year. At Pitt, for us, the worst time at Plaid. There have been a lot of those, thing that you're trying to do doesn't work, so on and so forth. There was one particularly dark period very early on, where we kind of, for a variety of reasons, had a Series A fall through and basically ran out of money. That was definitely a dark period for us. When entrepreneurs ask me what the best startup advice I have is, my answer is always just don't die. Because if we could have gone through that period and not kind of given up and continued pushing forward the company, truly, whether or not you do 10% better at the margins in the future, just don't die, and you'll have the opportunity to get there and see that. So that was probably the pit for me.
All right. Well, Zach, thank you so much. I'm going to quickly do a little credit reading and thank our audience. So once again, thank you to Zach for joining us today. I'm Jordan Crook, and my co-host today was Alex Wilhelm. Big thanks to the Extra Crunch audience for your questions and being here with us today. Extra Crunch Live is executive produced by Ashad Kulkarni and myself. Our live stream producer is Julio Barrientos, and our Q&A moderator is J.M. Donaldson. Alexandra Ames and Travis Bernard run our marketing efforts, and Richard Smith leads speaker programming. Next week, we will be talking to managing partner at Inspired Capital, Alexa Von Tobel. We'll also be talking to GGV's Jeff Richards and Hans Tung. Thank you again, Zach, for joining us, and thank you, everyone, for being with us today. Have a good one.
Thanks for having me.